Are you a developer navigating the complex world of joint development agreements or JDA projects? Do the terms GST, RCM, TDR and Barter transactions give you a slight headache when planning your next big project? If so, you're in the right place. Welcome to our deep dive into JDA projects and GST, what every developer needs to know. In this video, we are cutting through the jargon and simplifying the essential GST implications that impact your bottom line. We'll cover everything from the nuanced taxation of TDR, understanding your reverse charge mechanism, RCM liabilities, to the barter tax on construction services provided to landowners. Plus, we'll explain the critical differences in GST for the sale of under construction units versus developed or completed units guided by the completion certificate rule. Stick around because understanding these key GST aspects isn't just about compliance, it's about optimizing your project costs and maximizing your profitability by proper tax planning that we are gonna discuss in this video. Let's get started. Let's start from the basics and understand what a JDA is using this simple animation. In a JDA, there are two parties, landowner, developer. Landowner provides the land or the development rights for the project to the developer. The developer undertakes construction, obtains approvals, markets and sells units. In return for the land, the landowner receives a share in the constructed property. By signing a JDA, the landowner can save on cost of construction and the developer can avoid upfront land purchase cost. It's basically a collaborative model designed to benefit both the landowner and the developer. Now to digress a bit, if you are interested in income tax implications for landowners in a GST, I have a separate video on this topic where I have explained even the basics of JDA in detail. You can find the link in the description. Let's now talk about the JDA GST Roadmap. A JDA typically involves several transactions, each with its own GST implications. And this roadmap outlines the key stages a developer must navigate. First, TDR transfer, where the landowner transfers development rights to the developer. Then, construction service. Here, the developer provides construction as a barter service to the landowner. Next, unit sales, where the developer sells their share of units to third-party buyers. In between this first and second stage, there is one other key aspect that is worth understanding. Though this itself is not a stage in this roadmap, yet understanding this is crucial. It's called RCM Liability, where the developer is required to pay GST on purchase of certain goods or services from unregistered suppliers. More on this later. Before we jump into discussing this roadmap in detail, let's talk about certain classifications because understanding these classifications is crucial for applying correct GST rates. 1. Affordable residential unit. This is basically an apartment with carpet area up to 60 square meters, about 645 square feet, in metro cities like Delhi NCR, MMR, Bengaluru, Chennai, Hyderabad and Kolkata, or carpet area up to 90 square meters, about 968 square feet, in cities other than metro cities. And the gross amount charged for the apartment is up to 45 lakh. Now to quickly understand what this carpet area is, it is the actual usable floor space within the apartment excluding external walls, balconies and common areas. 2. Non-affordable or other residential unit. This is any residential unit which is not an affordable residential unit. 3. Commercial unit. This includes shops, offices, godowns and other spaces for business. Now let's talk about rate of GST. For affordable residential units, 1%, but you cannot avail input tax credit. On other residential units, 5%, again no ITC. On commercial units, 12%, but you can avail input tax credit. Now you must be wondering about mixed project, that is where you have both residential and commercial, then what is rate of GST? This is interesting. If the commercial space is up to 15% of total carpet area, then such a project would be a residential project. So you'll have to charge 1 or 5% GST as applicable and no ITC. The moment you cross this threshold, you'll have to charge 12% GST on commercial units, but you can avail proportionate ITC. Let's understand this with a simple scenario. Imagine you started a new project in Bengaluru. It's RERA registered. Plot area 1 acre, built up area 82k square feet, carpet area 58k square feet. For ease of understanding, let's say you're gonna build 50 apartments of 1000 square feet each, 50k square feet, and remaining 8k square feet would be commercial space. Now this commercial space as a proportion of total carpet area would be about 14%, which is within the threshold. So this entire project would be considered as residential project and you would be required to charge GST at 5%, but no ITC. Now what is the tax planning tip here? If you can limit your commercial space so as to be within this threshold of 15%, you would pay lower GST. GST on TDR, transfer of development rights, critically depends on the type of the project, residential or commercial. And GST liability on TDR always falls on the developer under RCM, reverse charge mechanism. Now what's this RCM? Generally in GST, the supplier is required to pay GST to the government. But in RCM, the buyer or recipient of service is required to pay GST to the government, and this is applicable on certain goods or services. And in TDR, buyer is the developer. Let's first talk about residential projects. If you sell apartments before CC, now what is the CC? Completion certificate. It is the date of issue of completion or occupancy certificate by local authorities like BBMP, BDA, BMRDA, and this is issued once the construction is completed. Now coming back, if you sell apartments before CC, no GST, but for apartments remaining unsold at the time of CC, you'll have to pay GST under RCM. Next, what is the rate of GST and what is the value on which you're going to pay GST? It is least of the two. 18% on market value of similar property at the time of TDR, or 1 or 5% on market value of unsold residential units at the time of CC. Then for commercial projects, it is pretty straightforward. Rate of GST is 18% and this has to be paid on the full value of TDR. To put it differently, there is no capping of 1 or 5% in case of commercial projects, but you can avail input tax credit. Let's understand this with a simple scenario. Let's say you are into a residential apartments project, non-affordable. Total project area 1 lakh square feet. Unsold area at CC 20,000 square feet. Market value of TDR rupees 2.5k per square feet. Market value of unsold residential unit rupees 5k per square feet. Let's now compute GST. First, value of TDR for unsold units. 20,000 square feet multiplied by 2.5k, that is 5 crore. Rate of GST is 18%, so 90 lakh. 2. Value of unsold units. 20,000 square feet multiplied by 5k, that is 10 crore. Rate of GST would be 5% because this is non-affordable, so 50 lakh. Least of these two would be 50 lakh, so you'll have to pay 50 lakh as GST. Had it been a commercial project, then the second option is not applicable, so you'll have to pay GST of 90 lakh. Now next question, when do you have to pay GST? Time of supply would be date of completion or first occupation, whichever is earlier. Now what is the tax planning tip here? If you want to avoid paying GST on TDR, then it's better to sell all the units before completion. In a JDA, the developer provides construction services to the landowner in the form of developed units in exchange for development rights. This is a barter transaction and we have understood this. But what is the transaction flow here? First, landowner provides land or TDR to developer. Developer provides construction service by giving finished units to landowner. And this service is taxable at 1, 5 or 12%. Developer is required to pay GST and a forward charge. That is, once you complete construction, at the time of raising tax invoice to the landowner, you'll have to charge this GST. Next, what is the value on which you're going to charge GST? This is market value of similar units that you have sold to other end buyers. Let's assume this value is 45 lakh and landowner share here is 10 apartments. So taxable value is 4.5 crore, rate of GST 5%. So GST that you have to charge would be rupees 22.5 lakh. Now what is the tax planning that you can do here? I can't think of any tax planning tip here, but ensure to comply with this requirement, otherwise you would end up paying hefty penalties. Before we talk about taxation of unit sales, let's first understand the completion certificate rule, because timing of sale is critical for GST applicability and the project's CC or OC acts as a dividing line. Let's understand this with a simple timeline animation. In the timeline, this is the date of issue of CC. If you sell before CC, that is sale of under construction units, is considered as supply of service and GST is applicable. And if you sell after CC, that is sale of completed units, is considered as sale of immovable property. No GST is applicable because immovable property is neither a good nor a service. Now what's the tax planning tip here? If you sell apartments after CC, no GST on sale of apartments, but you'll have to pay GST on TDR on such apartments at CC. So you'll have to do a comparison and choose what's best for you. Now let's quickly talk about GST rates on under construction units. Different rates apply depending upon the unit type, and we have already seen this. On affordable residential units, rate of GST 1%, but you can't avail input tax credit. On other residential units, 5%, again no ITC. On commercial units, 12%, but you can avail input tax credit. To understand this better, let's say price of an affordable residential unit is 40 lakh, rate of GST is 1%, so GST payable is 40k, no ITC. For other residential units, price 70 lakh, rate of GST 5%, so GST payable is 3.5 lakh, again no ITC. For a commercial unit where the price is say 1.2 crore, rate of GST is 12%, so GST payable is 14.4 lakh, but here you can avail ITC and pay the difference. Now let's talk about RCM liability for developers. We know in RCM, developer has to pay GST. But as a developer, when do you have to pay this GST? For construction work, you'll have to procure goods and services. Now this is important. You'll have to procure at least 80% of goods and services from GST registered suppliers. And this does not include certain items like TDR or FSI, also known as FAR, long-term lease, electricity, diesel, petrol and natural gas. So the moment you don't meet this threshold of 80%, you have to pay GST under RCM on the shortfall. Plus, if you procure cement from unregistered supplier, you'll have to pay GST on 100% value of the cement. Let's understand this with another scenario. For a particular project, let's say total inputs and input services needed is 100 lakh. Procured from registered suppliers, 75 lakh. Procured from unregistered suppliers, excluding cement, 20 lakh. And cement is also procured from an unregistered supplier, 5 lakh. Now the required procurement from registered suppliers is 80% of 100 lakh, that is 80 lakh. Actual procurement, 75 lakh. So the shortfall here is 5 lakh. GST on this shortfall at 18% is 90k. Next, rate of GST on cement is 28%. So 28% of 5 lakh would be 1.4 lakh. So the total GST that you have to pay under RCM because of this purchases from unregistered suppliers is 2.3 lakhs. Now what are the tax planning tips here? 1. Ensure to buy at least 80% of goods or services from GST registered suppliers. 2. Ensure to buy cement only from GST registered suppliers. To quickly recap GST for developers, before construction, 1. You'll have to pay GST on sale of under construction units at 1, 5 or 12% as applicable, but you can't avail input tax credit on sale of residential units. 2. No GST on TDR. During construction, 1. You'll have to procure at least 80% of goods or services from GST registered suppliers. 2. You'll have to procure cement only from GST registered suppliers. After completion, 1. You'll have to pay GST on TDR attributable to unsold units at 18% subject to a capping of 1, 5 or 12% as applicable. 2. No GST on sale of completed units. This was all about JDA projects and GST for developers. Hope it was informative. Thank you for watching.